In this video we'll talk about 2008 housing crash, what's going on recently in the housing market, and what do we expect in the housing market in 2023. The housing market crash of 2008 was a devastating event that affected millions of homeowners and the economy as a whole. But how did it happen and what can we learn from it? As housing prices soared, many people were convinced that the market would never go down. They took out mortgages they couldn't afford, and banks and lenders were more than happy to give them the money. Subprime borrowers were given loans they could not afford, and many of them were bundled together and sold as securities to investors around the world. But when the bubble burst, the consequences were dire. Millions of people lost their homes, and the ripple effect was felt throughout the economy. Unemployment rose, businesses struggled, and the stock market took a dive. Banks faced a huge amount of mortgage defaults and foreclosures, leading to a credit crisis, which in turn led to the 2008 financial crisis. It was a painful lesson that no one should take the housing market for granted. In May 2020, the median sale price of a home in the United States was $298,000. Fast forward to May 2022 and that number has skyrocketed to $433,000, that's a staggering 45% increase. But what's behind this trend? One of the main factors contributing to the rise in housing prices is the historically low interest rates. Low mortgage interest rates make it more affordable for buyers to purchase a home, leading to more demand for housing. Mortgage rates saw historic lows with 2.7%. This was great news for home buyers and homeowners looking to refinance, as it makes borrowing money to purchase or refinance a home more affordable. Another factor is the shortage of homes for sale. The COVID-19 pandemic has led to a decrease in the number of homes available for sale, which in turn has driven prices up. This is because, as the demand for housing is high but the supply of housing is low, the prices go up. Number of homes for sales had 35% decline in this period. A strengthening economy and job market have also played a role in the housing market's growth. As consumers feel more secure in their financial situation, they're more likely to invest in a home. Demographic changes, such as the aging of the population and increased migration to the suburbs, have also contributed to the housing market's growth. And lastly, government policies such as stimulus package and mortgage forbearance program have helped people to continue their mortgage payments, which also helped to keep the market steady. Now let's look at what's going on more recently. Well, there's been a major shift recently. In May 2022, the median sale price of a home in the United States reached its peak point, but since then, we've seen a drastic change. In fact, the median sale price has dropped by a whopping 10%. This is a significant change and it's worth paying attention to if you're thinking about buying or selling a home. Stay tuned as we dive deeper into the reasons behind this shift and what it means for the housing market going forward. First of all, the market was in an unsustainable rally for 2 years and it was only a matter of time before we saw a correction. The fact that it was unsustainable is one of the very reasons it is slowing down. The housing market has significantly outpaced wage growth, so even though we're in the midst of a housing shortage, far fewer people can afford to actually buy. Historically, an average house in the US cost around 5 times the yearly household income. During the housing bubble of 2006, the ratio exceeded 7. In other words, an average single-family house in the United States cost more than 7 times the US median annual household income. In May 2022, we saw a historic high in the price-to-income ratio. This ratio hit 7.8, which means that housing is less affordable than ever before. This is a significant shift, and it's worth paying attention to if you're thinking about buying a home or investing in the housing market. Another top reason that you already know in details is the Fed's interest rate hikes to fight against the inflation. The Fed's rate is now in a range of 4.25% to 4.5%, the highest level in 15 years. The Fed's policymakers are grappling with two conflicting risks: that they'll fail to raise rates high enough and thereby allow high inflation to persist, or that they'll raise rates too high and tip the economy into recession. An obvious outcome of the Fed interest rate hikes is the increase in mortgage rates. Compared to December 2021, mortgage rates jumped to 6.4% with 106% increase. To make this more relevant, here is an example. A $300K mortgage with 3.1% rate will result in $1,280 monthly payments excluding tax and fees. Same mortgage amount with 6.4% rate will result in $1,877 monthly payments excluding tax and fees. Traders in the Fed funds futures market expect the central bank to push the rate up to 4.75% to 5% by midsummer, then take it down half a percentage point by the end of the year. However, Fed officials estimated in December that they see the rate passing 5% this year and staying there, with no cuts likely until at least 2024. This means mortgage rates not coming down significantly in the next 1 to 2 years at least. Now let's look into how things are on the supply side. America is, and has been, in the midst of a housing shortage, even prior to the pandemic. To fix this problem, experts at Freddie Mac and Up for Growth as recently as 2021 estimated America needs 3.8 million new homes. If you ask the National Association of Realtors, that number may be closer to 7 million new homes. This means that any decrease in home prices over the next year likely has a floor. While less people who want to buy can due to high prices, the supply shortage will hopefully keep supply from greatly outpacing demand. Finally, let's talk about what's ahead of us in 2023 for the housing market. With all the given facts and recent trends, it is not very difficult to predict what is coming for the rest of this year. Most experts agree that the slowdown in home sales that beset the second half of 2022 will continue into 2023. Number of sales will continue to slow, likely hovering in the 4.5 million range, with new home sales at around 600,000. Listings may no longer go at a lightning-fast pace either. Days on the market have been climbing back toward more normal levels recently, and we could see them approach 30 days or more in 2023 as the market continues to cool down. Higher interest rates will undoubtedly hurt home values and pricing, but since the supply shortage problem won't be fixed anytime soon, the decline will probably have a floor. Some experts believe housing prices will go down by another 5 to 15%. Taking a big picture look at the possible real estate market next year, most pros are in consensus, something of a transitional year, characterized by uncertainty.